So the Fed has, in my opinion, added a lot to the volatility that we're seeing in the markets. And as I said off the top of the show, Mohamed El-Arian, Allianz chief economic advisor and president, Queen's College, Cambridge, was talking a bit about this in an interview in the past week. He says that a lot of the Fed governors are contributing to the volatility that we're seeing with respect to interest rates predominantly. And then, of course, the stock market takes its cues from the bond market. So the stock market volatility as well. And I think he pointed out two things. Number one, once upon a time, we heard from the Fed chair, whether it was Alan Greenspan, Ben Bernanke, but we didn't hear as often as we're hearing from Jerome Powell these days. We're hearing on a regular basis from Fed governors. Some are hawkish, some are dovish, some want to see more interest rate increases, some want to see less or hold on. And it's just confusing investors. And, this week alone, I think we're going to hear from anywhere between 8 and 10 different Fed governors talking or speaking about their opinions. And it just causes a lot of volatility. The other thing that Mohamed El-Arian pointed out, and again, I agree with, is this idea that the Fed is kind of reacting or speaking about a lot of the economic data in the rear view mirror, not kind of giving us a proactive way of looking at what's coming down the road, but more reactive to the data of to the data that we've seen over the past month or quarter. And I know the Fed has said that they're data dependent. So I guess we should expect them to be more reactionary versus proactive. But in my opinion, I think you want a Fed that is going to look ahead to a day where maybe we see 2.5%, 3% inflation. Is that good enough? The Fed will probably tell you no, on the cameras, in front of the cameras, but maybe behind closed doors, seeing an inflation rate of 2.5%, I think is manageable for the Federal Reserve and even for the Bank of Canada. So for me, this volatility that we've seen, bond market, the bond market, biggest market in the world, 10-year treasuries, 30-year treasuries, 2-year treasuries, sometimes they're behaving like penny stocks. We're seeing them move significantly in just a few hours or even minutes, depending on commentary out of Jerome Powell or the Fed. So I just think volatility has been ramped up, and a lot of it has to do with the Fed. And in some ways, even though we all want him to be more and more transparent, in some ways, I think I'd rather have him say less, be a little less transparent, give a speech every now and again, let the Fed governors speak every now and again, but not as often. And I wanted to end this segment off showing a chart of the VIX volatility index. And you can see here on the far right how much it's dropped off. VIX trading under 20 usually shows a calm market. And right now it's about 14, 15. So yes, the volatility index is not showing us that there's a lot of volatility out there, but you can see how many times the VIX has spiked and come back down, spiked and come back down. And the chart here, unfortunately, doesn't catch all the intraday moves or day-to-day moves. This is a one-year chart. I guess if we looked at a chart over a period of a few weeks in and around a Fed announcement, you really would see the ups and downs of the bond market, interest rates, and volatility. So hopefully the Fed going forward can maybe be a little less transparent in some ways so that we could see a little less volatility and make investors feel a little more confident in investing going forward.